Hi, good morning, everyone. Thank you so much for joining Phillip Security Research Monday morning call. Today we have Alphabet and Tesla earnings and AMD Phillip on the ground. For Singapore side, we have REIT result, including OUE, Suntec, and Keppel DC. Update and Phillip on the ground for SIA Engineering and also HPH Trust. For macro and sector outlook, we have SG Weekly and Technical Polls, as well as our REIT Monthly. This is our usual disclaimer. Please note that the information provided in this seminar is solely for educational purposes and should not be considered as a financial advice. Please do seek advice from a financial advisor before making any financial decision. So I will start the presentation with SG Weekly because Paul is away today for a corporate event. So for macro, the focus will be on property. First one will be with RMC, which is ready mixed concrete. At the moment, it is growing at 24% year to date. And the higher volume should, we think the higher volume should benefit operators like Hong Leong Asia and also Pan United. Recently, URA also released their usual quarterly numbers. The volume is still pretty soft. In the first half of 26, it's down 11% at a little bit over 4,000 units, which is below Pronext 9,000 units forecast. And the launch was also down 22%. We think that it could be a drag on Pronext earning in the second half of the year. In terms of the price growth, it still remain pretty flat at 0.5%. And inventory is still very low, so the demand is still very strong. So for secondary market, it is also down about 5%, and the HDB resales unit volume actually decreased around 7%. In terms of the technical views, REIT's performance is quite impressive with Suntec and also OUE REIT DPU up around 25% and 29% respectively, with most of it actually coming from interest expenses. Singapore now has the strongest geographically rental reversion because for office it's around 5 to 10%, and for retail it's around 6 to 11%. Moving forward in 28, we think the office might face some challenges because of the supply spike from 400,000 to 2 million units, while the demand will stay around 600,000. Yeah. And we see that the one that did not really perform well for REIT so far is Mapletree Industrial Trust because the DPU actually down about 5% and because half of the assets are coming from the US and focus on data center, and the occupancy rate is around 83% at the moment. As for the OUE REIT, it has a strategy pivot. They are currently selling half of the data assets and also expect to deploy more assets in Australia. The stock is now trading at 40% discount to book with a 6% yield. Hashim will provide more information about OUE in his presentation later. So in terms of the calendar, the event calendar is pretty packed this week. We have a FOMC meeting. We also have US GDP and core PCE. For US earning call will continue for other maximum company. And for Singapore side, we also have Sanxiong, Keppel, and also Citrum. Please also feel free to join our corporate insight webinar with Kin Global, Digital Core, and Core US REIT. The graph on the left is showing RMC demand is reaching the highest since 2012, and on the right it shows the unsold inventory compared to 12-month sales, which is now at around like 1.4 years. It suggests that the property market still has a very strong demand-supply dynamic. Next, we have HPH Trust. The earnings actually came in pretty strong and 23% year-on-year growth with unchanged dividend. Currently, they have a dividend yield of around like 8%. That's because, the good result is coming because the volume from China still remain pretty robust because of the war in the Middle East. But the port in China is still very e-commerce heavy. That's why they're performing much better compared to, for example, like Port in Hong Kong. Yeah. And moving on, I will present Alphabet second quarter results. So in which we title Record Cloud Growth, Elevated CapEx, Weight on Free Cash Flow. Yeah. For the second quarter, both revenue and adjusted PATMI actually grew 24% year-on-year to $119 billion and $35 billion respectively. Sorry, it was 45%, 42% of our financial year 26 forecast is slightly below our estimate, but do take note that this is because digital ad company they are subject to seasonality. Oh, sorry. So starting with the positive, Google Cloud segment actually reported the fastest growth. The revenue surged 82% year-on-year to $24.8 billion. While the operating margin actually expanded 15% to 35.6%. This is supported by a very strong enterprise AI demand. At the moment, 90% of the Fortune 100 company are actually adopting Gemini Enterprise. And another encouraging indicator we are seeing is actually backlog, which actually grew almost 4 times to $514 billion. And majority of the contract are still GCP contract. And Google mentioned that the TPU system sales contract will mostly be realized in financial year 27. And moving on, because of the supply constraint, they will start to use the third-party compute capacity from the third quarter in order to speed up their customer deployment. We think that by using the third-party capacity, it might have a short-term weight on margin. And because of this capacity constraint, there might be some pressure on revenue recognition. But we still remain positive on cloud long-term outlook. And at the moment, we still expect Google Cloud to grow around 72% in financial year 26. And the next positive is that the Google advertising business also still remain pretty resilient because the search revenue actually increased 17% year-on-year to $63 billion. This is driven by retail and financial vertical. But for YouTube advertising actually grew 13% year-on-year because of the strength in Shorts and CTV. And one of the indicators we are seeing that is actually pay click. It is now delivered double-digit growth for 3 consecutive quarters. It's now 13% compared to just 4% in second quarter of 25. We do believe that this growth actually suggests that Gemini integration is improving the ad relevance and also user engagement. And moving on for the second half of the year, we do expect that the advertising business to benefit from seasonal catalysts, including like FIFA World Cup and also US midterm election. And because most of the advertising company, they are now seeing the US political spend is on track to reach the record high, and they're expecting around 47% of the budget to be allocated to CDP and digital channel. Therefore, we do believe that it will provide some of the upside for Google ad business. So turning to the negative, which I believe that is the main reason why the post-earnings share price performance is not doing so well. Firstly, it's because of the higher CapEx. The management raised the financial year 26 CapEx guidance by around 8% to $195 billion, to the range of $195 billion to $205 billion, in order to expand their AI infrastructure, even though at the moment the operating cash flow is growing at 41%, but the CapEx actually grew double in the second quarter. This is why they reported the first ever negative cash flow of $5.9 billion. As for the view about the CapEx and cash flow, at the moment, we don't think that it is a sign of weakening fundamentals. We think that it is inevitable consequences of Alphabet AI investment cycle in order to support the long-term growth. And so far, we don't really see an issue on the CapEx affordability because, like I mentioned, the company still can generate a very strong operating cash flow. Together with when you see the recent debt and equity offering, it shows that Alphabet still has a very strong funding capabilities, so it should provide sufficient financial flexibility for them to fund off this investment. So overall, we upgraded our rating to a buy recommendation, but we do lower our DCF target price to $425. We reduced the PATMI forecast by around like 4% because of we do believe that there will be a near-term margin pressure. But despite all of this revision, we do have still have a constructive view on Alphabet long-term growth, because we do believe that vertically integrated AI ecosystem, starting from silicons to data center and also to a very leading frontier AI model, it should continue to drive the growth across both cloud and advertising business. So yeah, and that's all from me. Next, I'll pass the time to Glenn for Tesla earnings. Thanks very much.
Thanks, Serena. Yeah, so we'll just go through Tesla's results. Yeah, so the title is like record deliveries, but the margins collapse. So if you remember, I did speak about the deliveries maybe last week when they announced their second quarter deliveries, and it was quite impressive. But then again, I said to just keep a lookout for the margins, and if they can hold the margins up, that will be a very positive. But they did not. They were not able to, which is we saw their PATMI earnings, margins all collapse. So I think that's the main reason why they managed to push out so much of their cars. It's low from the lower average selling prices, right? And then that compress margins further for Tesla. So yeah, jumping to the results, the second quarter results did meet our expectations at first half revenue and PATMI at 52% and 51% respectively of our forecast. Looking at the adjusted PATMI, it fell by 17% year-on-year to 1.2 billion, mainly from the 47% jump in OPEX. They also had lower regulatory credits and the 240 million energy warranty charge, which offset that record deliveries number, and also the top line growth of 26% in terms of their revenue. Deliveries, it was up 25%, and this is a record second quarter. And also the deliveries, why is it on Suntec REIT? Sorry. Yeah, okay. Yeah, deliveries also exceeded production by 28,000 units, right? And this helped to cut their inventory to 15 days of supply. So the last quarter, they had 27 days of supply. So that's quite positive news. Energy deployments were also up 41% year-on-year, and this is the second highest it's ever reached. And for another good news is that the active supervised full self-driving subscribers grew by 56% year-on-year to 1.48 million. So it's still quite small, this base, so that's why we'll probably see it grow pretty healthily, at least for the next few quarters or even next 1 or 2 years. For the negative, we saw that free cash flow turned negative, right? It was at negative 1.1 billion as the capex more than doubled to $5.8 billion. I think this is something that we will continue to see moving forward. Yeah. So the capex guidance has been maintained, right? Reiterated at $25 billion. And the guidance from them is that capex will rise further in the second half in order to reach that $25 billion mark. And it will even extend for the next 2 to 3 years, right? And this is mainly for the Robotaxi, Optimus, their semicon fab, which they're trying to build with SpaceX, solar manufacturing, and also AI compute. Interestingly, they've also managed to secure some debt facilities, allowing borrowings of up to 30 billion. And their cash and investments also fell to 43 billion. For the outlook wise, they did say that it is actually the supply and not the demand which will be the constraint on second half of the year volumes, right? Where the bottleneck they're saying it will be mainly coming from the batteries and electronic components. Like I said earlier, the capex guidance, right, is still at 25 billion for FY26, but it will grow for the next 2 to 3 years. Right? We are still guiding it for it, we have some hope that the capex will not be so high because maybe they will be able to realize that this capex spend is going nowhere and they're just a car company. Yeah, so we're keeping our capex guided estimates for FY27 still around the $10 billion mark. Yeah, so this higher capex will continue to keep the free cash flow negative. The OpEx was driven by R&D and also the production costs for all their a bit of the non-car stuff, like the Semi, Optimus, and also CyberCab, and this will continue to rise. In terms of their energy margins, it will be normalizing at around the mid to low 20% range as the industrial storage average selling prices decline amid competition. So that's another negative for Tesla. CyberCab has finally begun production, and the Semi and Mega Factory will probably start this year. And the Optimus robot lines are also being installed at Fremont. Robotaxi is also live in 7 US metros, and they are continuing to expand this further. I think which will be in the near to medium term. For our view, we believe that the second quarter was better on demand, but as expected, right, it was worse on profitability and cash generation. As they needed to find some way to continue to sell their cars amid the very intense competition that they are facing. They also have the largest order backlog since 2023, and the FSD subscriber growth. I think these are the only two positives, but we do not change our core investment thesis and the outlook because the hardware margins are compressing, and the Robotaxi, Optimus, CyberCab programs are still, we believe, very far away from meaningful contribution. At a minimum, it will be 5 years, before they actually contribute anything. And on the negative side, if you're looking at a very pessimistic view, it could be even 10 years or more. The operating margin of 1.4% in this record delivery quarter actually shows the cost of their AI build-out, where they're spending so much money. And also, a lot of this growth in delivery numbers, right, which I think is the biggest positive, right? It's really coming off a very depressed second quarter 2025 base. So if you look at year-on-year, it's really because last year was very bad. So that's why this year they show they get the best improvement award. Yeah. So we are still quite cautious, for all these reasons, and also that very intense competition in China where they are facing from not just BYD, but not a lot of the domestic EV brands, right? Whereas Xiaomi, Geely, they're all stepping in, to give out better cars at even lower prices. So with all that being said, we still maintain our sell call with an unchanged target price of $220. Yeah. That's all for me. I'll now hand it over to Iqbal.
Yeah,
Thanks.
thanks, Glenn. I'll be presenting on AMD Phillip on the call. So they had their advancing AI keynote last week. Yeah, next slide, please. Yeah, so in the keynote itself, AMD touched on several points for their next generation products. For example, their GPU as well as their CPU. So in terms of CPU TAM itself, AMD guided by 2030, data center TAM is expected to reach $220 billion. So this is higher than their previous guidance of $120 billion. So effectively, they are seeing this market almost doubling because of the adoption of agentic AI. This is also almost in line with NVIDIA's guidance for CPU TAM, which is NVIDIA's guidance was $200 billion. And AMD also mentioned that their next generation CPU Venice is in production. In terms of GPU-wise, as you can see at the bottom right-hand corner, this is a snapshot taken from the presentation. AMD compared their CPU to NVIDIA's Vera Rubin, which is the darker shaded bars. AMD's Helios GPU is as shown by the light blue color bars. So AMD claimed that its Helios GPU is able to outperform Vera Rubin in terms of high bandwidth memory capacity as well as AI compute. We do have to take this with a pinch of salt because ultimately the performance data is being run by AMD, and currently there hasn't been any independent third-party vendors which compare the performance between these two products. For example, MLPerf haven't run the performance comparison for these two products, but AMD is able to back their strong Helios performance with facts itself. Because for example, in the recent weeks, Anthropic and AMD announced their partnership to deploy 2 gigawatt of MI450 GPU in the Helios rack scale designed by the first gigawatt will come online by the first half of next year itself. So there's strong demand from all these frontier AI companies for AMD's GPU racks itself, and this proves their strong performance in keeping up with competition. And AMD also secured other high-end customers like from OpenAI, Meta, Microsoft, Oracle, Humane. Yeah, so this shows that this backs the performance of Helios itself. In terms of our outlook, we do think that server CPU demand still remains strong. For example, Intel had their results last week, and Intel's data center revenue surged by 59% year on year. So this is a record growth for Intel's data center CPU revenue. We do think that AMD is able to benefit from this strong demand as well. And also for Google, they have increased their capex to build up AI infrastructure, as what Serena mentioned. We do think that other hyperscalers will also increase capex to build up AI infrastructure. This is to answer one of your questions as well in the Q&A. Yeah, so because we think that this increasing capex is being led by demand, and this demand we do think that it is indicated by the hyperscalers backlog itself. And because Google and other hyperscalers have shown an increasing backlog itself, we do think that this will translate down to increasing spending to build out AI infrastructure. And this will further drive demand for AMD as well as, for example, NVIDIA and the custom chip makers like Broadcom, Marvell. Yeah, so currently we are still positive on the entire semiconductor industry exposed to the high-end space. Yep. That's all from my end. I'll hand over the time to my other colleagues. Thanks.
Yeah, thanks, Iqbal. Yeah, I'll run through Suntec REIT's results. So the first half results as Singapore assets continued to drive performance. So this is growth, a very strong 24.8% DPU growth. And other than the strong Singapore performance, the lower finance costs also really helped. It was 11.6% lower financing cost year on year, or almost 10 million lower financing costs. Yeah, so for the revenue, the top line, the Singapore performance was very strong. So Suntec City was up 6.2%. So, but it was partially offset by some one-off compensation that was received in first half 2025 for 177 Pacific Highway. So that was of 8.4 million. For the JV income side, the properties at MBFC, the MBFC properties and the ORQ also performed very well. So it's up 12% and 11% respectively. Yeah, and distributable income increased mainly from the lower financing costs as well, and the absence of the additional withholding tax provision in first half 2025, which was based on no MIT status. So that has been reversed. So as a result, the DPU was up 25% year on year. So this was in line with our expectations. It formed about 52% of our FY 2026 forecast. Yeah, so looking at the positives, their core Singapore operations remain the key driver. So performance was very strong. Occupancy for both Singapore office and retail both increased. So it's now both at 99.5%. The office side, it saw rent reversion of 10.1%. But going forward, we expect it to moderate to around 5% for the full year, mainly because of Suntec City office, their expiring rents in the second half is much higher. So we're expecting it to moderate to around the 5% mark for the full year. For retail, it was 10.7%. We expect it to remain around current levels at 10%. So for office, the occupancy we expect to remain elevated. So that's mainly from the very tight CBD supply and market vacancy, and as well as there is a lot of demand from financial services and technology sectors. So the MBFC and ORQ properties are also seeing some expansion demand. So that's where the strong reversions are coming from. And for the retail side, major events will help to support that, like the F1 and BTS concert. So that will likely support tenant sales, which was up about 7% so far this year in the first half. So that's a very strong number. Yeah, so for the Australian property, so that remains a little bit challenged. Yeah, sorry, there's something wrong with my camera. Yeah, the The Australia property remains challenged. UK portfolio is there is some improvement there expected. So for Australia, the occupancy it dipped slightly. So now it's at 90%. So it's weighed by 55 Curry Street. So the 55 Curry Street, the occupancy it declined slightly to 61.1%. So Suntec is trying to adopt a flexible leasing approach. So like subdividing the space and catering more to the tenants. Divested tenants needs to help to in a bid to try to increase occupancy there. And for the Minster building in the UK, currently the occupancy is stable, but that is expected to increase to 94% as one insurance company lease is in the final documentation stage, so that's likely to kick in third quarter, and they're in a heads of agreement to send another tenant as well. That will likely bring it to almost full occupancy. So the UK properties is performing better, and these are the two assets in overseas assets in the portfolio that are performing weaker than the rest. So the others are close to full occupancy. Yeah, so looking at the financing or cost of debt, so it's 27 basis points lower year on year. Quarter on quarter is stable, but we still do expect a lower year on year savings from the lower base rate. SORA is still 100 basis points lower. So, however, we do expect to inch up slightly to about 3.6%. So currently it's 3.55%. And they have 57% of debt on hedge rate. For Suntec City Convention Centre, the performance is expected to remain stable. There is a healthy MICE pipeline in the second half of 2026 to provide the support. So this is despite the ongoing uncertainties from the Middle East conflict. So flat performance for the Suntec Convention Centre. And for the Suntec City Strata office unit divestments, so for the first half, they divested one unit. Second half, they are in the finalization stage of divesting another. So this is continuing from the very slow 2025 or so, only 22 units sold. So this is fall short previous annual target of about 100 million. This is mainly because they are keeping the price, so they're keeping about 3,350 that price level. So which is why the divestments are a little slower. For the Australian divestment that they mentioned, they want to possibly recycle some assets from Australia. The prospects are looking better for that. That's mainly because of there is a recovery in transaction activity, and there is also increased buyer inquiries, mainly from institution funds compared with a year ago. So there is a stronger interest for that. So it is more the chances of divesting this Australia is higher now, and there is an upcoming strategic review, so that the outcome of that might possibly provide more clarity into inorganic growth opportunities, like whether they want to perhaps exit or enter new markets and such, and also the balance sheet management. So currently the leverage rose from about 41.5% to 43%. That's mainly because they went to draw down debt to redeem the 150 million perpetual securities, the 4.25 perpetual securities. So that's why leverage increased. We think that will be on the agenda for the strategic review as well, when they try to manage that leverage to keep it at around 40%. So that's a very healthy level, and internal level that they also mentioned 40% leverage. Yeah, so with that, we must maintain our accumulate call. Our TP increased from the very strong performance of Singapore, so we adjust our numbers upwards about 5%, our forecast for FY26. The dividend yield is about 5.5% for Suntec REIT for forward FY26. Yeah, moving on to Keppel DC REIT. So, next slide, please. For Keppel DC REIT, the acquisitions and higher rents drove the 11% DPU growth. So acquisitions was the Tokyo DC 3, which saw a full period contribution, as well as the remaining interest in Keppel DC SGP 3 and 4, as well as positive rent reversion. So all these also increased to the higher gross revenue, which rose 14.5%. So this is partially offset by the divestment of Kelsterberg Data Center. The Quantum Data Center side, they still continue to provide for loss allowances, so that's already inside the numbers there at MPI. And for finance costs, it increased mainly from the acquisition loans taken. Yeah, and for distributable income is up 18.5%, but looking at the DPU, it's just up lower by 11.3%. That's mainly from the enlarged unit base from the equity fundraising that they did to acquire for previous acquisitions. So overall up 11%, so that's still a very strong number. Yeah, so this DPU of 5.71 cents was in line with our expectations, about 52% of our FY26 forecast as well, similar to Suntec REIT. Yeah, so for the positives, their balance sheet is very strong. So their leverage is at 34%. So this leaves a lot of ample debt headroom for them to pursue accretive acquisitions. So they've been acquiring many property. They made many accretive acquisitions over the past few years. So it's better to continue. So this leaves at 34% leverage. This leaves about close to 700 million debt headroom to their internal cap of 40%. So if they're willing to bring it up to 50%, there will be much higher debt headroom. Their cost of debt also inched up slightly to 2.7%, but it still remains very low. It inched up slightly mainly because they took on more hedges for their SGD loans. So now their percentage of debt that are hedged, it increased to 87% from about 83%. Yeah. So for the negatives, we saw a slight dip in portfolio occupancy. So the portfolio occupancy declined from about 95.6% to about 92.5%. So this mainly from the lease expiry at the Cardiff data center. So now they're fully focused, and the priority is to find some tenant to backfill that space. The reversions for first half 2026 was at 10%. So second quarter was about 5%. So this moderated. It is noted that they've already guided that reversions will really be very volatile. Like some quarters will be very high, some quarters will be like more moderate, like 5%. That's mainly depending on the lease expiry profile of the tenants or which lease are renewed. So going forward in the third quarter, we do expect the reversion should be very high. That's mainly because they did a lease renewal for Gore Hill data center, so that will come in the third quarter. So it was noted that the rents at that property has doubled. So rental reversions will be very high for the third quarter and for second half 2026. Yeah, so for the quantum data centers, they'll continue to recognize losses. So over 60 million in overdue rent so far. So if they do manage to recover that 60 million, that will be a huge catalyst for them. Currently in the forecast and our numbers, we do not account for any contribution from the quantum data centers at all. Yeah, so but despite the decline in the portfolio occupancy to about 92.5%, revenue 95% of revenue generating power capacity remains contracted. So the decline in occupancy is not really is less significant. It's not as reflective as the revenue decline from the occupancy dip. Just mainly because of the contracting power, still 95% contracted. And yeah, like I mentioned, for the outlook, we do expect reversions to improve. So that's mainly driven by the Gore Hill data center as well as some Singapore co-location renewals that we do expect at higher rents. And for the structural demand is still there. So it's driven by cloud computing, AI adoption, and ongoing digitalization. So that's for data center demand. And for acquisitions, they are still focused on that. So they have a healthy debt headroom for acquisitions as well. So they're looking at established hubs only, like Japan, South Korea, Europe. And they also have a preference for hyperscale customers. So maintain our cumulative call. So we have a higher target price as well as $2.46. And Keppel DC REIT is paying a yield of 5.1%. Yeah, next slide, please. Yeah, so I'll move on to our REITs monthly. So we do expect DPU growth in first half 26. So this was before the report was released before the earnings season. Yeah, so it is coming to play so far. Like we saw 20% DPU growth for both Suntec and OUE and Keppel DC REIT 10%. So yeah, DPU growth is still expected. Next slide, please. Now look at the share price performance. Year to date is still down 6.2%. For month of June, it's up slightly 0.4%. Yeah, so diversified, which was CICT mainly. CICT drove the performance. So Singapore has actually remained very strong and resilient. So that's similar to Suntec REIT as well. Next slide, please. Yeah, so looking at the dividend yield spread, so it's been creeping up over the past few years, and we do expect it to increase further, mainly from the DPU growth that I mentioned. And yeah, this 20% DPU growth for some REITs also is exceptional. So over time, we do expect this DPU growth to increase the dividend yield spread, assuming other factors remain constant. So at about 3.8% dividend yield spread, we think there is attractive levels at a historical, slightly above the historical levels. And the 3-month SORA still remains very low. It's been inching up slightly over the past few days. Now it's about 1.15, but we still expect to remain around these levels. And year-on-year wise, is down almost 100 basis points. So that's where we will still see year-on-year interest cost savings. Next slide, please. Yeah, so looking at the forward dividend yield, yeah, like I mentioned, so we do expect that to increase from just a pure absolute DPU growth. And for S-REITs index price to NAV trading at around 0.94 times, we think this discount is unwarranted. It should be trading towards historical average in our view. That's mainly because we believe the market is pricing like interest rate hikes, so that's also why it's trading a discount, and as well as possible cap rate expansion from the higher interest rates. But we don't think cap rate will expand significantly this year, even for overseas assets, mainly because our operations has remained stable. So possibly just at most, maybe just a slight 5 basis point cap rate expansion, so that will result in lower valuations, but we don't think that will really come into play this year. Maybe next year if the Fed does raise interest rates. But the silver lining is that Singapore assets remain the most resilient, so limited cap rate movement expected there. Asset valuations remain very stable. We've seen transaction activity also in Singapore also remain at least at book value. So valuations have remained very resilient. Yeah, next slide, please. Yeah, so looking at the retail sales figure, yes, it's very resilient in May. So over the past few months or so, it's around low to mid single digit level, 3.7%. And also recently, the Singapore Business Association, they did a study on the JB RTS impact. So we made some comments here. So just an overview of their study. Their study showed that there is a net incremental outbound spend of about 290 million annually. That comprises of about 100, or rather 1 billion of Singapore consumer spending in JB, and increase in JB spending in Singapore of about 750 million. So the net amount of incremental outbound spend is about 290 million. So this 290 million is just 0.4% of Singapore's 2025 retail and F&B sales. So the impact expected or retail spend leakage is really not really that significant. So this is in line with our earlier estimates, like we've mentioned many times over the course of the previous presentations as well. So looking at which sectors would be affected. So the Singapore outbound trips are mostly is for value-driven categories, so such as groceries, drugstore, dining, and beauty and services. So these sectors might be impacted, but the JB visitors expected to drive further demand for premium retail in Singapore, entertainment as well, and more experiential type of lifestyle in Singapore. So our view is that the impact on Singapore retail REITs for this RTS is expected to be manageable, not very significant, as you need to, as investors need to realize that it's just the incremental spend or leakage that we're talking about, as currently already a lot of Singaporeans really go to JB to spend. So we're talking about the incremental, so that is really just 0.4%. And also a lot of these Singapore retail REITs, they are anchored by necessity spending, F&B services, and this experiential offering. So this is less substitutable to those like categories like I mentioned, the beauty services and drugstores and such. So over time, we do expect retail landlords also to adapt and optimize their tenant mix, and also to reposition their malls towards a more experiential concepts. So and lifestyle offerings as well, and differentiated experiences to capture more cross-border demand from the JB travelers. So over time, we do not expect much impact, and we do expect these retail landlords to really adjust their tenant mix to support that. And those well-managed retail malls, we do believe there is potential for incremental footfall opportunities as well, for if they manage to attract more tenants with their tenant mix, and rather attract more visitors with their tenant mix. Yeah, so in conclusion, we don't expect a material headwind that the RTS brings on retail REITs. Yeah, next slide, please. Yeah, looking at hospitality sector, the RevPAR numbers and visitor arrivals year to date is quite lackluster. Visitor arrivals still down year to date by 1.7%. RevPAR is down 5% for the month of May. However, OUE's hospitality results, which Hashim will talk about shortly, they did surprise on the upside for the hospitality sector. So we are continue to monitor to see whether how the other hospitality REITs will be impacted by these kind of weaker Singapore numbers. Yeah, but so far OUE REIT has been more resilient. Next slide, please. And yeah, this is our coverage and target price and such before the first half results. Yeah, that's all for me. I hand over to Hashim. Thanks.
Thanks, Darren. I'll go through OUE results. Next slide. So their revenue was up about 3.8% year on year. This is mainly because their hospitality segment did quite well. So their Hilton Orchard Hotel RevPAR increased 12.6%. Crown Plaza increased about 7.5%. So the reason why their hospitality segment did well is because they were able to price their bookings at a higher rate. And for Hilton specifically, what we observe is that they benefited from corporate account wins, mainly from the US, because Hilton is known as a corporate brand in the US. And so in terms of travelers from the US booking at Hilton, it increased about 4% year on year. And for Crown Plaza, even though international visitor arrivals were down, they were still able to benefit from your transit travelers. So there were rerouting of aircrafts during the US-Iran war, and people needed a place to stay overnight. And the hotel that they preferred was Crown Plaza because it's right beside Changi Airport. In terms of your DPU, it increased about 28%, and that's mainly because of finance costs falling. So finance costs fell about 17%, and cost of debt also went down about 60 bips to 3.6%. We expect that to fall further. So what they guided was, if they use Crown Plaza proceeds to pay down debt, their leverage will go down from 41 to 36%, and that's not including your One Raffles Place divestment proceeds. Their JV also did quite well. OUE Bayfront profits were up 30%. Also mainly from the interest cost saving from refinancing. They are also currently converting level 17, which was a chiller space previously into office space now, and they are targeting to complete that by first quarter next year. So negative wise, we might see some weakness in their office segment occupancy. It was down about 4% percentage points year on year. And going forward, we think that the backfill time it will take for Deloitte, who's leaving from OUE downtown, it might take some time for them to fill up this space. And the One Raffles Place that's currently going through a sale process, what we learned was that there might be a weakening leasing inquiry. So new tenants are a bit more reserved in terms of wanting to rent a space at One Raffles Place because of this whole sale process going on. And lastly, because of this OUE Bayfront chiller space conversion, there might be some tenant reshuffling that can also cause some vacancy for the near term. So outlook wise for the OUE downtown building, about 500 Deloitte employees might still be housed there. 1,300 would move to Just Coast Orchard Central location that is made up of 2 floors that's being converted from retail space. So backfilling for this space at OUE downtown, mainly inquiries is coming from your banks, your TMT, as well as your startup sectors. So lastly, One Raffles Place, the bidding process is already concluded. So what OUE REIT guided was that they have gotten bids from well-capitalized investors from Singapore. And the end goal for them is for them to redeploy all these proceeds into a Salesforce tower. So Ping An is already putting out its stake 50% since September last year. And what we learned is that it's still in the market. So once One Raffles Place divestment closes, they will likely take these proceeds and then redeploy it into a Salesforce tower, which they already have a stake in. So we have buy on them with TP of 45 cents, and it's trading at a yield of 6%. Next slide. So next I'll go through SIA Engineering update. Next slide. For SIA Engineering, their revenue was down about 8.6%. This was mainly because of their work scope that they performed during the quarter. So this quarter, they had lower materials related revenue. So in terms of revenue, you have your materials revenue, you have your direct labor costs, and lastly, you have your outsourced repair costs. So for this quarter, their materials revenue was lower. So if you look at the table below, you can see that there's different types of MRO work. You have your base maintenance, engine maintenance, line maintenance, components. Typically, your engine and components tend to have a higher proportion of materials revenue as compared to base and line maintenance. So in terms of the type of work they did this quarter, it was less heavy checks, less managed fleet size involvement. So all this is related to changing your parts, which tends to have a higher proportion of materials. So that was down, and so their revenue was also down. But operating profit was up 159%, because your material cost is largely passed through. And excluding materials, your revenue would have been up 4.2%. Negative wise, their engine and component JV is currently expanding. Main expansion cost is your Cecil. They are trying to expand at Seletar and Loyang, and they are increasing their engine servicing capacity from 300 engine to 400 engine. So that has caused profits to go down about 20% year on year. So management confirmed that this cost will peak this financial year, but overall, the operations are still strong. Their volume of engines that they worked on year on year is still higher. So outlook wise, what we observe is SIA Engineering is strengthening its foothold across APAC. Previously, they signed a inventory technical management agreement. So that's your components business with Air India. Air India, the SIA Engineering is also Air India's base maintenance partner in Bangalore. And just recently, they signed a non-binding MOU with Air India for a full MRO JV. And we think it's quite likely because SIA already has a stake in Air India. So it's likely that this MOU will go forward. And in Malaysia, they are expanding. The second hangar is going to be online second half 2026. And SIA Engineering is also opening up a new JV, Safran Engines JV. So that would allow them to capture the increase in demand for LEAP engines. And lastly, they just recently took a stake in China for MRO. So they are establishing themselves very well in terms of capturing APAC MRO demand. So we have a buy on them with TP of $4.06. So with that, I'll pass on to Zain.
Thanks, Sachin. Good morning, everyone. I'll move on to the technicals. Next slide, please. Next slide, please. Thanks. Yeah. Okay. So first up, looking at the S&P 500, last week was down 0.6%, so it was a second consecutive week decline. In terms of the price action, I think there was a retest of the 5 SMA level, which was this blue line you see in the chart. Price actually last week continued to stay under the 7,500 level, and then below the short-term moving averages, the 5, 10, 20 SMEs as well. So at the end of the week, we retested this upper support line, still holding over there. I think it's quite important. So I think for now, we're likely to see some sort of a sideways consolidation here, with resistance coming from the short-term moving averages, like currently at 7,450, that's the 5 SMA level, and 7,490, we have the 10 and 20 SMA levels. Yeah, in terms of support, that will be currently at 7,400, which is this upper support line. And then if it goes under that, the next support level is likely at 7,345. So I think currently at the support area for now, we are likely to see some sort of sideways movement with resistance still likely close to 7,500 and above. Yeah, so that's all from me. I think we can move on to the Q&A. Thanks.
Yeah, let me take on some of the questions. Yeah, someone asked about iFast. Yeah, I'm actually also listening into their call on my phone because they're having their analyst call now. But I'll just try. I couldn't really listen much, so I'm just recording it. But just based on what they released so far, sorry, let me find my notes. Yeah, for iFast, I think the top line they did quite well. If you look at the top line, revenue up, everything is up. AUM, AUA is up. But if you look at the profit, right, it's not growing as fast as the top line. And especially if you look at the OPEX growth, right? OPEX growth is actually growing faster than the revenue growth. So there's a bit more of spending that they need to do in order to continue growing, right? And I think they did say that the headcount will peak in middle of this year. So this should be the last quarter where we are seeing such high growth in terms of OPEX. And that margins will hopefully improve from next year onwards, right? So I think that will be the bigger driver, because if even though your revenue grows so fast, but if you can't control your OPEX, that means you are being like a startup. Basically, we're just growing at all costs. Yeah, so I think that's why their share price didn't do as well. In terms of Hong Kong revenue grows quite well, but the margins, again, right, the same story, it did fall quite a bit, right? From 39% to 31%. Yeah, so I think it's a lot of it is shifting from the migration and onboarding, which they did previously, right? The first 2 years where they had to more like just normal everyday day-to-day sort of like admin work. Yeah, so I think that's where it will slow down a bit. Net inflows were also up quite well, right? So the thing we are looking at is that they are shifting from lower margin towards lower margin products, right? So you're seeing like stocks and ETFs are growing quite strongly, right? Which is to be expected, and bonds are only up like 3+%, yeah, compared to like 12.5%. And then you see the stocks and ETFs section growing like 50-odd% compared to like 20-something% previously. Yeah, so I think that's where we see the big shift. The other big thing is the iFast Global Bank. I think that's what they are trying to push quite hard. It was up 175%, so very big number. But then again, we must take note, and this is the profit before tax, right? It's only 1.92 million, right? Even though it's up 175%. So you just have to take note that this is a very small base year on year. Yeah, so the growth will be very strong, right? If you look just at the percentages wise for the next few quarters, I predict, because they are still very small, right? So now it's easy to grow where you are just trying to get a lot of the customers, and a lot of people are quite curious. So they're growing very fast and growing quite well. But because they're small, I think when it starts to stabilize a bit more, when they're a bit bigger, then we can see how fast they can sustain this growth. Yeah. DPS also very healthy, right? They did raise it, for FY 26 to be around 12 cents. Yeah, so that's a big increase in the guidance for their dividends. Yeah. Yeah, I think that's all for iFAST. We don't cover it, so yeah, a bit hard for us to give any recommendation or even target price for iFAST. Okay, a few more for Tesla. Yeah, someone is asking, how is the inventory bottleneck going to be fixed for Tesla? Yeah, so it's not really an inventory bottleneck. I think you meant like production bottleneck. Yeah, so the production bottleneck, inventory, yeah, I think you're talking about production. So for production wise, it's the main way they're going to fix it, right? They have the battery and electrical components. Those are the two sort of bottlenecks they're facing, right? Firstly, battery packs is that they're going to expand it in terms of building more facilities, right? They have a pack capacity in Berlin and also in Nevada. So that is where they'll be trying to bump that up a bit. For electrical wise, it's a bit more difficult because it's mainly just chips and memory, and everybody's in the AI race now. So they're fighting for the same pool of chips, right? And memory wise. So they are trying to get a lot of supplier commitments, right? Look at Micron, Samsung, TSMC, Panasonic. And I think the biggest thing is that they're trying to build their own development fab in Austin, right? Under the Terra Fab thing. But I believe that will be quite we won't be anywhere in the near term. Like it doesn't, you can't just build this kind of fab, like development fab overnight, right? It takes years and years of R&D and capex, right? And a lot of, not just, even if you have money, it's not just enough. Yeah. So I think it will take quite a while, yeah, for this. But we can see them trying to move towards where they are producing their own chips and memory instead of just depending on outside sources. Yeah, so that's where a lot of the capex is actually going. Yeah, someone's asked, what is Optimus mainly used for? Yeah, good question. We don't really know yet. But if you're looking at what Elon Musk is saying, if you do listen to any of his talks and calls, right, even when he's sometimes on random podcasts, he says that he wants Optimus is the robot, right? Okay, sorry. Optimus is the robot that they are trying to build. So they want Optimus to be basically in every house, right? Where it will replace your helper or your maid, right? Or it will just be like a personal butler. It can do anything for you. On top of that, apart from the retail side, right, they're also looking at the production side, more of the enterprise side where the robot will help to do a lot of the manual labor, right? So it's like construction, those kind of things. That is his end goal, right? But for now, we don't really know what it's going to be used for. Maybe just showcase, bring you coffee or something. Yeah, I think that's the main thing. So probably we'll only see it in hopefully 5 years' time where we'll actually see it being sold, and being used. Right now it's a lot of pre-production, so we don't even know what it's capable of. But if you look at China, you can see a lot of the robots, they can even dance and stuff like that. Yeah, so I think it could be a possibility. I think got one more on what to look out for the Max 7. Yeah, so Tesla already released their results. I'll let the rest, talk on the counters that they cover for the Max 7, so everyone can just take this question later. Yeah, and negative free cash flow for Tesla. Yeah, so for Tesla, so it's quite simple. It's just operating cash flow minus their capex. Yeah, so that's why you get the negative 1 billion cash flow. So they had operating cash flow of 4.7 billion and then capex of 5.8 billion. Yeah, so that's where you get the 1.1 billion of negative free cash flow. Yeah, one more on the banks. I think I answered. I typed the answer out, but it's asking whether or not what is the new target price. So we do have the target price. If last week I did mention the target price for the Singapore banks. So we upgraded, we updated all the target prices for the 3 banks and raised it. So there's DBS is $76, OCBC is $28.50, and UOB is $43. Yeah, I think everyone's expecting a bumper quarter. And also a lot of that, you see now the tech sector is being hit quite badly, right? Not just Max 7, but a lot of the tech stocks. And I think it's all flowing somewhere, right? You can't really put it into a fixed deposit, right? You get like 1% and you lose to inflation. So a lot of them are just going to the safe havens. The safe havens, right? Firstly, Singapore. So that's where, Singapore is benefiting. Secondly, the banks are also benefiting, because if you look at the whole Singapore, the SDI, if you want to go from somewhere more risky to somewhere safer, right, the best bet is Singapore banks, right? Because they pay out such good dividends. Even at the current prices, you're looking at 4%, 4+% for DBS dividends. And this is more or less assured all the way until the end of 2027. So you're getting like a 4% per annum kind of return on a very, very safe company. And and that's not even inclusive of any capital gains you get if the share price appreciates further. Yeah. And the whole environment for the banking sector in Singapore especially is looking very positive. You're seeing interest rates finally inch up, but it's still remaining low, right? So that's very positive for loans growth as well. Deposits are flowing into the Singapore, the whole Singapore banking sector, right? So there's like essentially free money for the banks, right? Where they can just loan it out because loan growth is so high, right? So it's a bit like a circle that is just positive for the banks. And then the last one is the provisioning is also very low, right? And they're all over provisioned anyway to begin with, right? So even if there is any downturn or a bit of a downturn, right, we will probably see them being able to cover. I guess the most at risk one in terms of provisions would be UOB, but even then they did that preemptive provisioning in the third quarter last year. So they're already buffering up, right? In order to, I guess, you want to compare with DBS and OCBC, right? They say, okay, at least we do something. So even then, they have done something. Yeah. So yeah, I guess the Singapore banks, that's the main reason why it has ran up so much. Yeah, it's a bit hard for us so to keep the share prices are just rising. Yeah, one more on Tesla. Do you reckon potentially Tesla? I think you mean Tesla, right? Will be merged, and for Tesla, will it be potentially commingled into SpaceX to hide the downsides? I'm not sure which downsides you're referring to. Maybe if you could, I'm not really sure is which downside you are referring to. Like whose downside? Because for Tesla, yeah, they have downsides, but at least they are still making money, right? And they have something that they're selling. I think SpaceX is even more downsides than Tesla, right? You're seeing them just trying to pump so much money into the AI segment, which is still loss-making and causing the whole company to be loss-making. I think it's probably the most highest market cap listed company that is still loss-making. Yeah. You can see also like in terms of their share price here, it's not doing as well as it was previously, all the hype. Yeah, so SpaceX, yeah, I think they're just both trying to cover each other's downside. Yeah, TP and OCBC is lower. Yes, so we did raise the TP last week, only last week. I mean, not last week, 2 weeks ago. Yeah, so no change to our TP for now for OCBC. Yeah, when the results come out, then we will look at it again. Yeah, sorry, one more from Ian again. Tesla is facing increasing competition from Chinese EVs and margin erosion. Yes, you're right. You have also projected lower TP on Tesla before. Yeah, I think I'm the lowest in the market now. Previously was JP Morgan. Then they changed their analysts. And also, I mean, they are also one of the front runners for SpaceX, right? So they can't really be that negative on Tesla. So we have always, our Tesla target price has always been around the $200 mark, at least for the last 1 or 2 years. Yeah, and it's been declining, right? I hope it might even reach my target price. Yeah, so they are facing increasing competition from Chinese EVs and margin erosion. Yes, you're right. Not just that, but also the cost of chips and memory, because their cars depend. It's basically a moving computer, right? So their cars depend very heavily on chips and memory in order to perform as what it is, right? Which is what Teslas are bought for, right? And now that they're going to put fuel cell driving inside, or the autonomous driving, right? It depends even more heavily on the chips it's not like a typical ICE or petrol car where you can just drive it. You don't even need to have a radio playing. You can just drive it because it uses an engine and petrol to run. Yeah, so for Tesla, yes, Chinese EVs is one, and then margin erosion from a lot of other things. Like there are increased cost of the memory and chips, and also competition from Chinese. And it's not just Chinese. You have to take note that their largest market is to the US. So they are still they are facing a lot of competition from US car makers, right? Hyundai, you see Ford. A lot of the car makers in the US are also, coming out and say, hey, we're also making EVs, right? Yeah, there's definitely, I mean, I have a sell call and the target price of $250 on Tesla. Yes, definitely lack of optimism on Tesla. Yeah, I've had this view on Tesla for the longest time. Yeah, I believe it's all very hype driven now, and people are just buying into the founder and the CEO, which is Elon Musk. Yeah, same for we don't cover SpaceX, but same for SpaceX as well. A lot of it is just a pipe dream and hype driven, right? Yeah. For SpaceX, the biggest thing you must worry, I mean, since I'm talking about it, is the lock-in periods. The moment that releases, you'll see a flood of a lot of the shares going back into the market. Now it's only around like 5% free float. So once the insiders, right, all the employees and the shareholders that had stocks, right, or even the VCs that invested into SpaceX before that, once they release it, they want to cash out, right? They bought it in, I don't know at how much, right? But they want to cash in, right? So they want to cash in and take their money, right? Because they invested in this highly risky company, right? So we'll see the demand, the supply suddenly spike, but demand is still run by the few, the same base, right? Which is basically a lot of the retail investors who is driving the share price up. Some insti also as well, but mostly I think it's the retail that is driving share price up. So once it starts to flow into the market, the supply, right? You look at basic economics, the share price will just tank again. Yeah, that is my view. Yeah, I don't know right or wrong, but that's my view where some mechanics, right, where it was you just strip off the fundamentals of the company. Yeah, but we will probably see the share price decline a bit more, especially for SpaceX. Yeah. Okay, I think I've talked enough already. Let me hand it over to the rest of my colleagues. Thanks.
Thank you, Glenn. Just take on some of the Magnificent Seven earnings. So Apple and Amazon are releasing their earnings this Friday morning. For Apple, we think likely it's going to be a solid quarter. The upgrade demand still appears really healthy, given by the phone report, particularly in the China market, which they previously have not been doing well. They have been actually struggling for the past year. Because the higher memory costs have actually benefited them, because iPhone are generally considered more premium compared to the lower end Android phones. So they're apparently less affected by the increasing price. So their customers are more sticky even when the price slightly increase. But it matters more is what's going to be their gross margin guidance and next quarter guidance, because of the component cost inflation. So if it persists, then it's still eventually going to impact their margins, and they might be forced to increase the price of their phones. And also we want to hear whether there are any strategy coming up from Apple that's trying to make sure that its customer stays. So actually just starting from this week, they're rolling out a very interesting program called the iPhone Upgrade Program, which they're trying to make investors think of iPhone usage less like a product purchase, but more like a rental. So you're signing an agreement with them for a specific period where monthly you pay a payment. So by the end of that period, you get the phone as your own. So that's like a buy now, pay later, which they always have. But what kind of change is now, anytime during the period that you decided that, oh, I don't want the phone, you can return it to them. And then you no longer need to pay the monthly payment anymore. Or if at any point they launch a new phone and you decided that you want a new phone instead, then you can sign a new lease agreement with them. So you're thinking of it more like a Netflix subscription. So monthly you pay a certain amount of money, to rent the phone for your own usage. And that rental fee is going to be much cheaper compared to your buy now, pay later monthly settlement. But exactly how much, they haven't really rolled out the numbers. I guess we'll have to see because they're rolling out this week. And also we're looking at their comment on their iPhone launch schedule. So there are rumors that there's going to be some delay. So we do expect the Pro, Pro Max, and the phone models to be launched first, but some of the lower price models might be delayed until March. So we'll see how they comment on that. With regard to Amazon, I think the main positive will still be another acceleration in their AWS, judging by Google's strong cloud growth and huge backlog. So we kind of expect the same coming from Amazon. The demand coming in from AI workload, their backlog and Anthropic related activities, they sure support growth. But a lot of the focus will also be on CapEx, whether they're going to increase their CapEx again, because they're trying to get source some funds through bond sales. So that kind of signals that they're not very comfortable just depending on their own cash flow. So we want to see their comment on that. Yeah, so I'm gonna leave the question there still for my other colleagues to answer. I think that's all from me. Thank you.
Wait, Helena, how about the Samsung Galaxy one?
I don't see the question. I'll answer it later. I'll pass it to my colleagues first. Thanks.
Yeah. Thanks. I'll take on some questions. What's the difference between GPU and CPU? Yeah, so GPU mainly does parallel processing. So for the most heavy workloads on inference, for example, it needs GPU. For CPU, it's mainly sequential processing. That means, for example, if we think about PC usage, CPU generally does the simpler workloads, like for example, opening a file explorer, opening a Word document. Whereas for GPU, it does the heavy processing of, for example, your graphics. For example, when you are gaming, each frame will require some parallel processing of the graphics itself. So that's the difference between GPU and CPU. Yeah. What's the difference in use case between Vera Rubin and AMD Helios? What are these used for? Yeah, simply speaking, they are used for the same use case whereby they are used for training and inference of data for AI workloads within data centers itself. So that's the use case for these two GPU racks. And because right now with the use of with the high adoption of AI chatbots, agentic AI models, that's why there's a huge demand for these GPU racks because they are the infrastructure supporting the running of these models. Yeah. How to determine a good GPU from a bad GPU? Yeah, so there's different metrics. Some key ones include, for example, the peak throughput, which is measured in flops, which is the number of floating operations per second you can run. So the higher the better. And you can also think of it as efficiency. For example, how much tokens the GPU can process per unit per dollar. So the higher tokens you can process per dollar, the lower the total cost of ownership, which is what a lot of hyperscalers are looking at. Other metrics can include, like for example, performance per watt, which helps the hyperscalers to save energy and reduce the energy usage. But I think the main one is still peak throughput and as well as the efficiency. Is Intel and Google a competitor of AMD and NVIDIA? How to understand the universe? Okay, so if we think about the universe of this CPU and GPU, right? Let's talk about CPU first. For CPU, in the market itself, there's two main players. Currently, Intel, it holds about 60 to 65% market share. AMD is about 30 to 35% market share. ARM holds a very small percentage, and NVIDIA recently announced they will enter the market, the CPU market. Yeah, so that is the entire CPU market. So if you think about the market itself, Intel is a competitor to AMD. Then if you look at the GPU market itself, the biggest GPU player is NVIDIA. It holds about 90+% market share in GPU. The smaller player is AMD, about 10%. And uh, this is purely for the GPU market. So if you think about a substitute for GPU, which is custom AI chips, which hyperscalers are now adopting to slowly replace the use case of GPU itself, that will be where Google comes in, because Google has the TPU, which is the tensor processing units, which is able to have a higher efficiency as compared to GPU itself. So that's why it's not a direct competitor to GPU, but it is a substitute to GPU. Yeah, but we don't see it as a very strong threat at the moment, because GPU has its place to stay in this space of inference and training for AI models. What's the main demand of buyers for GPU and CPU? Yeah, the main demand and buyer is the hyperscalers. The four biggest are Google, Amazon, Microsoft, Meta, and also coming up slowly is the sovereign nations, for example, from European Union, European Commission, the UAE, South Korea, basically nations that are building up their AI infrastructure, and also from enterprises, because currently the companies are trying to build out their own AI ecosystem as well. Yeah, so those are the main demand for this GPU and CPU. Why Intel went down after the results? Was there anything negative? Do you think it's a buy now or weakness? Yeah, I would say the results largely is positive. It's a double beat. Basically, they beat the guidance and they provided positive guidance. I think it went down because I think a lot of these positive sentiments are baked into Intel share price already. Their forward PE is about 95 times before the earnings announcement. So compared to currently average is about 35 times to 40 times in the high-end chip space. So Intel is trading at a huge premium. Yeah. After it went down, currently the forward PE is still about 70 to 80 times. So Intel is still trading at a premium. Another small negative is that the entire PC market is softening because of the high memory cost. So I think the PC OEMs are not actively stocking up inventory. So that's why there could be a softening of PC chips this year. Yeah. So that could be why it drove the Intel shares down. Yeah. If do I think it's a buy now or weakness? I think for Intel, you have to have a very long-term view on it, like long-term positive view on it, because Intel is developing the advanced packaging which could rival TSMC, and they are also in the advanced packaging business. So I think for this to be executed well, you still need to take a long-term view on Intel, at least like a 3 to 5 year view. Yeah. For me, I think AMD is still a better pick, yeah, compared to Intel. SK Hynix ADR, if not wrong, the unlock date of its IPO should be 28 July or this week. Yeah. And also a follow-up. Any views on its price movement with the unlock date? Yeah, so July 29 is the date where the Korean exchange allows the ADR to be converted to the Korean SK Hynix stocks. And I think there could be a lot of volatility and liquidity flooding in, because before that, the Korean exchange bans the conversion of this ADR to Korean shares, because many institutions could buy all these cheap Korean shares and after that convert to ADRs and earn the arbitrage. But after this July 29, this conversion is allowed. So there could be some selling pressure on the SK Hynix shares. So in the short term, I think the share price could take a hit, but in the long run, we are still positive on the memory players, because memory is still a strategic asset, especially in the hyperscalers and also in Tesla, the physical space. So we are still positive on, for example, SK Hynix, Micron in general. Yeah. On AMD, can I share what's their negative and challenges? Yeah. I think for AMD, one of the risks is that it is trading at a premium as well, similar to Intel. I think the forward PE is about 60 to 70 times, about 65 times, yeah, forward PE. So that's one risk. The other risk is that also similar to Intel, their PC segment may face a bit of softening demand, but PC makes up only a small component of their revenue, about I think 30 to 40%. The main bulk is still from data server currently. So we do think that this data server growth will be able to offset this PC softening easily. Yeah. Any updates and views on micromechanics? Yeah, so for micromechanics, I think they have secured some new customers, memory customers, and they are also ramping up NPIs from the existing advanced packaging customers. So I think their results should be good in the next few quarters, especially with this surge in demand from TSMC's increasing capex guidance, as well as the foundry players increasing capex guidance. It will flow down to equipment makers and memory players, and also subsequently in this micromechanics itself. Yeah, and memory players also increase their capex guidance. Yeah, so that's positive for them. My views on Pan United outlook and its target price. Yeah, so our target price hasn't changed. Outlook wise, we are positive because I think, yeah, so for this year itself, we are expecting the ramp up of construction project offtake. So because in 2024, 2025, construction levels are very elevated. It's about 65% above the historical average. So last year, the construction contracts awarded is about 50 billion. And after the contracts are awarded, it will flow down to the companies executing on the projects itself. So this will come in this year itself. And because Pan United has a 40% market share in ready-mix concrete, which is crucial in construction projects, we do think that they will benefit from it. And we also think that they will also benefit from margin expansion from their in-house technology platform, the Air Digital. Yeah, so that's why we are positive on it. Yeah. I think I'll hand over the time to my other colleagues for now. Yeah, thanks.
Let me take some question, I think, a little bit. So the first question is IBM SCVs now competitor to the NVIDIA and AMD? Are they in the same space? No, they are not. IBM SCVs are not in the direct competitor. NVIDIA and AMD is selling hardware, chips, and so on. IBM SCVs now mainly software platforms, so they are not really in the same space. Why are IBM and Adobe prices drop and tanking? They also not the beneficial of the AI boom and demand from the hyperscalers. Just to answer the first question with IBM company. So for IBM, so both of these two companies are not really the direct beneficial of AI, I would say, like not largely benefit from AI like the other company. For IBM in particular, recent result shows that the customers, instead of buying the usual product of their group product called IBM Z, which is a supercomputer to process large amount of transaction quickly, instead of buying the usual product, the customers in return buy more on the AI equipments, which is the other business segment that they have, which is like servers, storage, and so on. This in return slowing the growth is not as what they expected initially, and that's why the IBM share price dropped, I think about 24 cents in a day last week or 2 weeks ago. So that's why IBM is tanking. For Adobe, well, this in particular, the user growth of their product remains strong because the company prioritized expanding the free user base before they monetize it strongly. So we do think that in the longer term, they do benefit because of, they get plans, premium plan upgrade and so on, Firefly, AI Acrobat adoption, a lot of other plans. But then again, if you look at this sales metric, what we call annualized recurring revenue, in the near term, it's not going up. it's not going anywhere. It's just moderating or just stagnant. So hence, recently in the software quarterly, we downgrade application software generally to neutral from buy call, because we don't think that the company valuation could re-rate back up in the near term, because even if AI is not going to do well as what people expected, software in particular, not everybody is going to benefit from it. We don't think that in particular Adobe is going to valuation to going to rate it up again, because now spending more of them, enterprise spending is shifting more toward the AI initiative instead of the software budget. So if your software is not integrating AI as what people want, then you're not going to perform well. So, and then what earnings expectation this week, Microsoft included. So we expect positive earnings result for Microsoft. Probably earnings in the range of 20% strong earnings growth, driven as usual by the AI-driven Azure growth and strong cloud demand. The demand for the cloud is still above the supply as what we have nowadays. AI infrastructure spending should continue to translate into a strong revenue growth, especially in the Azure and AI services. We are seeing strong earnings, sales growth for this product, which is at 40% growth rate. Even at the second largest cloud providers, they are still providing 40% growth. That's quite astonishing. And we do think there's a possible meaningful rally in the stock market price if the forward guidance and Azure growth and outlook continue to be a strong bid as what people expected. And next question is why Oracle shares is sliding down. Is this the time to buy? Oracle, in usual, the shares is quite highly volatile. Last year, it plunged by 50% and then it goes recover back to 200 and then it goes plunge again, So for this time in particular, it's because it's like another episode of the Oracle defaulting concern, which happened in the last 2025, but this time because of the DeepSeek concern and also because it happened again concern. So recently, S&P Global, S&P downgraded to BBB negative, so this further weakened on the sentiment. But we stay positive and buy call at a TP of 237. We do think that near-term debt servicing remain manageable. The shortest bond matured in 2029 and then 5% yield. We do think that operating income is going to grow at 48%, surging in 2029 when all their targets data centers is up and running. So by then, free cash flow would turn positive and the revenue would surge, accelerate, and so on. And yeah, hence we have buy call. Is this the time to buy? Yeah, I mean, it's quite cheaper than it was historically. So that is all for me. I will hand over to my colleague to answer some of the other questions.
I can take one question on SIA Engineering. Despite the potential and positives that outweigh negatives, the share price doesn't reflect any baggage or headwind that can hamper SIA Engineering. So I think mainly two headwind or baggage. First is your sector-wide risk associated with aviation. I think investors are mainly exercising caution on the aviation sector as a whole, even though SIA Engineering might be considered lesser risk than, say, a airline. But you might have seen the news. US has stopped attacking Iran. Your Brent crude price is also going down, and I think the risk for SIA Engineering is lower on that front. And I think second or more important headwind is their engine and component JV. So for their share of profit from associate, what's different from other companies is that SIA Engineering, 80% of their bottom line comes from their associate and JV. So the impact from revenue is not that much, but the impact from your share of profit from associate and JV is quite huge. For SIA Engineering in specific, they are expanding for their associate and JV. Their CSL is still in an expansion phase, and so they are spending more money. And that is also something investors are wary of, because what the management guides is investment spending to be peaking this financial year, but they haven't given us any specific point in time. So this financial year could be later down the year, or it could be by the end of March, which is when their FY ends. So I think there is some concern over that. But overall, I think their engine GV is going strong. SIA Engineering, I think, made it clear that they are shipping more engines year on year. So operationally, they are doing well. It's just that they're spending money to expand, and that's affecting their bottom line. I think that's all, and I'll pass on to the others.
I'll quickly answer some of the questions, starting with the Make 7 earnings expectation. For me, I cover Meta, so I think for this earning calls, I think people will be very focused about their comments about whether they really want to start a AI infrastructure business and eventually become a cloud business. That's the first thing. And the second thing, when it comes to the ad business itself, the first one will be focusing on, since they integrate MuleSpa, which is their LLM, with the recommendation model in the ad business, we will see that if there is any ad revenue upside. Also, hopefully, they will give some of the metrics about how's the latest LLM's performance. Is there any metrics that shows the efficiency, since that they actually delay MuleSpark because of that. And when it comes to CapEx, I think it really ties to about the comment about their cloud business. I mean, if they do, I mean, eventually they want to build a LLM, and then LLM business, and turns out they need to build an AI ecosystem so that they have more pricing power when it comes to acquiring the customer. So if they really want to have this additional revenue stream, it makes sense that they have a higher capex. If not, then I don't see they actually raising it, to be honest. And there's another question about Alphabet funding. So the question is, how is Alphabet funding its doubling of capex? Is it purely cash, since non-SGD rates are going up? So I hope it's not that. So it's a combination of cash, debt, and also equity offering. So like I mentioned it, even though they do want to purely using cash, but because of the generation is not as fast as the capex spending, so that's why their debt portfolio actually grow double, like since last quarter. But you can see at them, Alphabet as a company, they actually have a top tier investment grade bond. So when you look at their effective interest rate, it's pretty similar to US government bond. It's around like 4 to 6%, meaning that they are actually paying very little money in order to borrow that money. And then for equity offering, that it helps with their cash and cash equivalent. But management in this earnings call, they did mention that so far they will rule out further equity offering in order to avoid any share dilution, unless this is ATM program. But the purpose will be more focusing to fulfill the tax obligation in order to instead of funding the AI investment. But overall, it is a combination between cash, debt, and equity offering at the moment. Yeah. There's another questions about Reddit and Alphabet. Sorry, let me pull up questions. Yeah, they will report Reddit is threatening to block Google from using its content to train AI. What's the impact to both company? Honestly, I do believe that if it really happens, when it comes to investor sentiment, it will affect Reddit more than Google for two reasons. The first thing is because this is a $60 million revenue that you don't really need to raise any capex. You just use your data, user data, and then you have this revenue on a yearly basis. And the secondly is that Reddit actually is one of the most reference cited website on Google. If let's say there's really no agreement, it will actually hurt a little bit of their clicks as well. But of course, for Alphabet, it will, the main purpose of this data licensing is really to train the LLM. I mean, to have more human conversation that it will make it more efficiently. But without it, since Alphabet also has the search business itself, so I do think that when it comes to impact, it will affect Reddit a little bit more than Alphabet. Yeah. Yeah. And I think that's it for me. Yeah. I think I'll pass the time to my other colleagues for other questions. Thanks.
Sorry, I
Yeah.
didn't see the Amazon question earlier. So sorry, I go first. So who's the main customer of Amazon? So Amazon have a lot of customers. They have a lot of large enterprise on their cloud infrastructure, and those are just big companies trying to use their service. And these are companies like Netflix, BMW, Adidas, I think Airbnb also. And then they have this AI customer, which is this just whole AI circle where everybody is collaborating with everybody and everybody is somehow a competitor with everybody. So within this big circle, their biggest clients are Anthropic. So Anthropic now trains and serve their cloud on AWS. They've also committed 100 billion of further AWS spending in the near future. And then they also invested in OpenAI. So OpenAI is now their models available through their Amazon Bedrock. They've also committed more than 100 billion of spendings over the next few years. Then the big players like Meta and Snowflake, they've also signed a huge dollar bill when it comes to AWS infrastructure agreement. Google, I wouldn't say Google is a big customer of Amazon. Maybe they do have some Google teams. They do have some services on AWS, but I would say it's a very niche area. So Google and Amazon, they're more like competitors. They're competing for the same batch of customers, but not necessarily Google is a customer of Amazon. So I hope that clarifies. And there's a question on Netflix. Can I give an update on Netflix? Is it still buy rating? Any change on the target price? So we actually just released a report on Netflix last week because they just released their earnings. Our target price is $110. So it's actually a buy rating. So not much change in our narrative when it comes to Netflix. We're still seeing they're the industry leader. They have very strong pricing power. They recently increased their price again, and membership trend seems still very healthy. It was very well absorbed. There's no sign that engagement deteriorated, but the market kind of crashed because their guidance for the next quarter is relatively soft because their content coming up in the second half of the year is not as exciting as last year when you think about Wednesday, Stranger Things, and Squid Game. All these are very big blockbusters. But we think essentially there's nothing wrong with the business. So you do have to allow that sound cycles. They don't have that much exciting content coming up. But when it comes to the business as a whole, we think it's still a very healthy business. And with the share price coming down so much, we do think it's a pretty attractive valuation for now. Just now Glenn mentioned somebody asked about Samsung. I'm sorry I can't find the question. So just a brief summary. So Samsung had an event last week where they launched the new Fold 8, which is a continuation of the previous Fold 7, the foldable phone. It's noticeably wider compared to the Fold 7, so it's easier to use when you even close it. It's much better for the videos, better for reading documentations and all that. And then there's also the premium end of the phone, which is Fold 8 Ultra, which has better camera, larger batteries, and more higher end specification. This time they've emphasized on agentic AI a lot, so there's going to be a lot of new AI capabilities integrated throughout the device with Google Gemini powering many of the features. And they've actually increased their price a little bit due to the increase in memory cost. So across the entire lineup, each one was probably about $100 more expensive compared to the last time when they launched. And Samsung, when it comes to global phone shipment, they recently reclaimed a #1 position again. Last year it was caught up by Apple because of their very strong iPhone 7 17 launch up, but now they reclaim number one position. So they're also the beneficiary when it comes to memory price increasing, because their target audience is also considered more on the premium side. So they're less affected when there's a change in price. So I'm sorry I missed your question. So if you do still have burning questions on Samsung, just do leave it in the comment section and I'll try to answer them. Yeah, pass back to you, Darren.
Yeah, thanks, Celia. Let me try to take on some. Before handing over to Zane for the TA, what can we expect from UI Boston REIT results? Yeah, so the thing to look out for UI Boston REIT results is whether they can meet their initial IPO guidance, a DPU growth of around 4.8%. So that's a key thing. And also at IPO, they mentioned that they do expect their portfolio occupancy to increase from about 93%, possibly to around 95 to 98 level. So we also keeping an eye out on that, the occupancy. And also for the commentary on rental reversions, because I think they at IPO they also guided for about low to mid single digit reversions, and also they did have some strong acquisition pipeline and capital recycling and such, like the just slipped my mind what was the co-investment. Yeah, the build to suit facility, aerospace facility at Seletar Aerospace Park. So all those will start to contribute in the longer term, but nearer term, yeah, the key thing to look out for, especially for these results, is the DPU growth, whether they can meet their initial guidance. Yeah, should be able to, right, in our view. Yeah, but we don't cover them. So longer term growth is really their portfolio recomposition, their co-investments and their development potential. MIT dividends slashed by 5%. Any chance of reversing this in the coming years? And their data center occupancy performing badly in the US, occupancy rate 80+%. Data center glut in the US. Yeah, so actually data center is very different. Like all those high data centers that can support like AI and all those more high specification type of data center, they are in high demand. But for Mapletree Industrial, their enterprise, their data center maybe caters to enterprise users. So that's why the so-called the demand is not as strong. And if you're asking any remedial actions or mitigations by management on this, so yeah, that is really the divestments that they set up that they said. So they are looking to divest some of these poorer performing data centers and even with vacant data centers. So that is what they guided for the actions. Any other than that, any chance of reversing? Yeah, if they can divest that and possibly release those data centers, then yes, the dividends in the longer run might slowly improve. But in our view, in the near term, still a challenge. There are North American data center portfolio, so dividends likely to won't be, the performance won't be that good. Likely still see some DPU decline over the next few quarters minimally, until at least they can do a turnaround, like possibly divest some assets and reinvest into higher yielding assets, then possibly DPU can increase. But in the near term, we're still seeing a DPU decline. Yeah, so generally for the US, like your question, data centers decline in the US is older facilities in secondary markets and less power efficient data centers. Most likely those are the ones that will face more pressure, but those hyperscale AI ready facilities still very high demand. Yeah, and for Mapletree Industrials, their data center portfolio mostly is those older data centers that caters to enterprise focused clients. So that's the issue for that. Will lackluster tourist arrival numbers impact class results? Yeah, so for class, basically for Singapore, we are looking about less than 10%, about 9%. But for class, generally we still expect their results to remain resilient because they are backed by stable income sources. So over 60% of their income comes from master leases and management contracts from minimum guaranteed income. So we do expect some resilient performance of class. And also there's also guided that they basically the DPU will be at 6.1 cents. So basically any absence in that they'll likely top up with previous divestment gains, of which they still have over 300 million that's sitting in their books. Okay, next question. What is your view on Celine Tang's appointment as Suntec REIT chairman? Yeah, so we are positive on that. Mainly because Celine Tang now basically the Tang organization now they are the major shareholder. So it basically is alignment of interest, and it also raises the prospects of more capital recycling and portfolio optimization because of her expertise in the property market. Yeah, so we do think it's a positive, but we have to wait for the outcome of the strategic review to get more news. But for now, we see it as a positive. Suntec City shuttle office got how many total units? Yeah, they have over 150 units, but they all differ in size. Yeah, so that is 150 is all the towers combined for currently Suntec's REITs stake. Yeah. So they own over 150 units. Why redeem perps for Suntec REIT? Yeah, because they could draw down on cheaper debt to refinance the 4.25 perps. So that's why they redeem the perps in the near term. Yeah, to save on that interest costs. If all the REITs benefit from interest cost savings, then how to determine which REIT to buy since interest cost savings saving price already in place? Yeah, so not all REITs will benefit from interest cost savings. So some REITs they still have some of the cheap debt that they took on like 5 years ago that has yet to fall off. So once that falls off, some of the REITs will start to expect increases in interest rates. And also now that a lot of like the Bank of Japan, ECB have really and RBA have risen their base rates this year. So it is expected that some of these REITs with overseas markets will start to see some of these foreign debt the cost increase, but it is mitigated by higher or rather the percentage of debt that is hedged to fixed rate. Yeah, so that the fixed rate that could cushion it. Yeah, but if you want to determine which REIT to buy, you still have to focus on the operating performance, not just interest cost for sure. So that is whether they can sustain the top line can sustain like with positive rental reversions and rental escalation. So basically rental growth. That is so very important other than the fact that just purely looking at interest cost savings. Yeah, so year on year, we do expect like over 70% of the REITs still benefit from lower interest costs or at least stable. Yeah, but quarter on quarter, yeah, because some of the rates have really gone up, so we do expect to see some possible increase quarter on quarter for interest rates for some REITs. Yeah, Kelsterbeck data center contribute how much to GRI for Keppel DC REIT? Yeah, so previously, Kelsterbeck data center contributes about 2.6% of GRI for Keppel DC REIT. Yeah, so now it's been divested as of the first quarter of 2025. How about bond yield outlook for the yield spread for REIT dividends? Yeah, so for bond yields, currently around 2% for Singapore government bond yield for the 10-year. Yeah, so with interest rate expected to remain so-called elevated, we do expect the bond yield to remain around current levels as well. So how about bond? Yeah, so that is our outlook. Yeah, but the REIT dividends we do expect it to increase, like I mentioned. Yeah, so another question is why JB drive premium retail, is it cost rich JB coming to Singapore spend? Yeah, so there are two portions of this. So one portion is like the JB people coming to Singapore to work. So probably when they come to work, then maybe they'll spend at those suburban malls, and for F&B and such. Maybe not so premium for this segment of the JB people, but for those JB people coming to Singapore for leisure, so most of the time we do expect them to come towards the town area, Orchard area and such. So that is where they'll drive the premium retail spend. I mean, we don't expect those people from JB when they come to Singapore for leisure. We don't expect them to probably go to Pasir Ris or Jurong or Tuas or something like that, right? So when yeah, so that's when we mean JB will drive the premium retail. So that's for this segment of the leisure travelers from JB, not those that are coming to Singapore to work. Yeah, I think there's still quite a few questions. I'll leave 10 minutes to Zane to do the TA. Yeah, thanks. Yeah, I'll type in the rest.
Thanks, Darren. I'll move on to the TA questions. Yeah, so let me just share my screen. Yep, so first one is on Franken. So I think for now, Franken, I think overall the momentum is still a bit weak. You can see on the MACD is still currently below the zero and basically just kind of flat and slightly declining. In terms of the share price, recently has been generally finding some resistance, mainly along the 10 SMA as well, this red line. And then another retest of the support area, which is like 261 to 264 again. So I think over here, it is quite important to if not, we might see some possible continued decline towards to test maybe 254 as the next support, yeah, which is quite close to the lower puncture band level as well. And in terms of the main resistance, I think could be at the 20 SMA level and above, which is like 279. And that's for the daily time frame. In terms of weekly time frame, also with some weakness as well. Price is, I think the main resistance of the weekly is the 5 SMA, which is this 273, this blue line over here. And yeah, price has been staying under that for about four weeks. Since the breakdown at this 298 at the end of June. Next one for UOB. For UOB, I think for now, I think we might see some slight resistance, but I think won't be that big. So price, there was a gap down on 17 July over here, and then share price still recovered. Overall, still very steady uptrend. And then I think for now, maybe some resistance from the breakdown, this 43.50 level over here. And yeah, but I think price overall will still likely find support from the consolidation last week. So the resistance last week was 43 about there. So I think that will likely hold as support, and then I think price will slowly go up to test the resistance area again, which is like 44.30 to about $45. So on the weekly time frame, I think also just still very solid uptrend. We can see price is still holding the weekly 5 SMA level since like May, and then the pullback was just a retest and continue to find support. So I think overall still trending up pretty well for UOB. But next one for Hong Kong Land. For Hong Kong Land, I think overall still quite a strong momentum in the short term. So since the breakout of this 745 level over here, you can see the movement which is stopping upwards previously was downwards and flat. And then currently also some consolidation last week at this 775 previous support breakdown level, and then today price managed to break out this reason. So I think overall in the short term wise, we still likely to see some positive momentum up to test the next area of resistance, I think, which is about 810 to 820 area, which was previously this in the middle of May this year, there was a support breakdown and then retest of it, the acted as resistance, then price pull back from this area. So I think that will be the next resistance area to test for Hong Kong land. Okay, then next one, I'll move on to some of the US counters. So first one, starting off IGV, which is the software sector ETF. So for this, I think overall, after a period of consolidation last week, we saw some weakness coming. So price, firstly, I think there was a breakdown of the short-term moving averages, this 20 SMA level on Wednesday, 91.70. And then also this like support area, which is about $89 to $90.50. Yeah, so some with weakness as well. And then I think in the short term wise, we're likely to see, I think, some weakness coming. We could see price retest the previous swing low levels, which is like around the 84 to about 86 region. Yeah. And then this $90 above will likely be a bit of resistance. Yeah, and then on the weekly time frame, I think after some consolidation of weekly, I think price also has been generally finding resistance at during the rebounds, a slight rebound at the 10 SMA level. This red line 92.60 about there for about 3 weeks. So generally a very weak rebound from the 20 SMA weekly. There's a slight rebound, and so yeah, so it could still shows the share price weakness in the short. Okay, next one on Walmart. So for Walmart, I think overall the trend is still quite weak in the short term. Ever since the breakdown out here after the earnings on 20th of May, I think currently is around this key support level, this trendline support over here. And then for Walmart, I think last Thursday, so we tested this swing low. So some swing low at around $107. So some bounce over here right now, but I think reasons might come in from about 110, this 5 SMA level and above to about 112. I think that will be main resistance. You can see on the daily time frame, key resistance has been around the 20 SMA level, this yellow line over here. On the weekly, also we can see that price is so generally finding the quite a resistance on the 5 SMA weekly with this blue line over here. So still quite still generally weakness for now. Yeah, then for Microsoft also some weakness, I think, from last week. So price previously, price still couldn't get past this resistance level at 401. So couldn't test the next one at 410. And then also in terms of the short-term momentum, during this rebound, price was holding support at the 10 SMA level, and then also this 390 horizontal breakout level as well. So with the breakdown, I think price short-term wise, we're likely to see some weakness at the 390 level, which will break down over here, and then the 5 and 10 SMA level above it as well. So I think could test the swing low again around this 373 again. Yeah, then we might see some slight sideways over here. Yeah. Okay, next one for Meta, I think bullish momentum I think has ended for now with price at the start of last week was holding at this 10 SMA level. Previously was at price book down the 5 SMA level, so the very short term momentum. And there was no bullish strength, and then afterwards you can see a breakdown. Then afterwards price just went down. So I think for now it could see continue some weakness if it comes back to test 580. I think there will be some support to hold for a bounce. Then short-term wise resistance, I think likely to be from the 5 SMA and 20 SMA level. This around the 620. I think there will be quite a bit of resistance. So I think we'll overall be in this 580 to 620 range over here. Okay, I'll take one more on Google since it's about 1 o'clock. So for Alphabet, I think after the results, I think price is for 2 days in a row, I think tested the 200 SMA level, this purple line, and currently staying under. So I think this is also like the first time price is under this 200 SMA level, I think since about May last year. So still some weakness for now. I think overall we could see if price breaks below the Friday lows of 370. I think we might see a retest of the next support level over here at 311, and then next one there's a gap over here at 305 as well. So otherwise still we could still likely to see some weakness overall with resistance currently at this there's some resistance at 324 200 SMA level, and then if it goes back up towards 331, there's also likely to be a stronger resistance over here. On the breakdown, they swing low and the 5 SMA level sloping down as well. So short-term wise, I think still I see some weakness in terms of share price movement. So I think that's about one. There's still quite a lot of questions we are unable to answer. So apologies for that. But feel free to post in our Poems 3 community, and then we'll try to take it over there. Yeah. And then in terms of our corporate insights webinars, we have a few companies this week like King Global, Digital Core REIT, as well as GDS Global. So feel free to dial in, and you can ask questions to the management as well. So that's all for today. On behalf of my team, I would like to thank everyone for attending and also for all your questions, and we hope to see you all again next week. Yeah, so hope you all have a good week ahead, and see you. Bye bye.